5.39 trillion.
That is a staggering amount of zeros.
It really is. 5.39 trillion Turkish lira. That's the number we need to start with today. It's the total asset size of the institution we're looking at.
And to put that into perspective, you're not just looking at a bank's balance sheet.
No. You're looking at a figure so colossal that it essentially mirrors the trajectory of the entire Turkish economy.
It's not just a bank. It's a financial ecosystem.
Welcome. Today our mission is to decode the 2025 Consolidated Financial Statements and Annual Report of Türkiye İş Bankası, or as most of us know it, İşbank.
We've got the 147-page technical document right here. It's from the independent auditors at PwC, and it covers the period ending December 31st, 2025.
And our goal today is to cut through all the jargon. I mean, this report is dense.
Oh, it is. It's full of TFRS 9 accounting standards, credit risk models, all sorts of consolidated subsidiary data. We're going to distill this down for you, the retail investor.
Right, for the person who wants to know. Is this giant agile? Is it profitable? And, where is it vulnerable?
We want the signal, not the noise.
Exactly. So let's first get to know the company a little.
A great place to start. You can't really understand İşbank's balance sheet without understanding its history. It wasn't, just popped up by some venture capital firm.
Not at all. It was founded on August 26, 1924, directly on the instructions of Mustafa Kemal Atatürk,
The first national bank of the Republic era.
And today, it's headquartered in those massive İşkuleleri, the East Towers in Levent, Istanbul. They feel like a fortress physically, and as we're about to see, financially too.
But it's not just sitting in a tower. The reach is incredible.
Tell us about it.
Domestically, they're operating 997 branches. That is nearly 1,000 physical locations, supported by a workforce of over 20,000 employees.
And that's just inside Turkey.
Right. What often gets overlooked is the international footprint. They have branches in the UK, Iraq, Kosovo, Bahrain, and the Turkish Republic of Northern Cyprus.
And even that is just the bank branches. When we talk about this being a consolidated report, we're talking about the whole group. This isn't just about checking and savings accounts.
Correct. This is a financial empire. The group includes TSKD, that's the Industrial Development Bank, plus banking operations in Germany, Russia, and Georgia. Then you have the whole insurance arm.
Anadolu Sigorta, Anadolu Hayat Emeklilik.
Plus leasing, factoring, real estate investment trusts.
It's basically a financial supermarket. If it involves money, they probably have a subsidiary for it.
And that diversification is key to their stability. But there's one thing about İşbank that makes it completely unique in the banking world.
I think I know where you're going. The shareholding structure.
Exactly. This is where it gets really interesting. This isn't your typical Wall Street ownership model.
Far from it.
The largest chunk of the bank, 38.66%, is owned by the İşbank Pension Fund.
So the employees, the current and retired employees, effectively own the largest share of the bank.
Yes. Think about what that does to the culture. It has to.
It has to, right? You're not just working for a paycheck, you're working for your own retirement fund's solvency.
Absolutely. It tends to drive a more prudent, long-term approach. And then there's the 28.09%, the Atatürk shares.
And this is the part that always confuses foreign investors. These shares are represented on the board by the Republican People's Party, the CHP.
They are, however, and this is a crucial distinction, the CHP does not receive a single kuruş of the dividends.
Not a penny.
Per Atatürk's will, those dividends go strictly to the Turkish Language Institution and the Turkish History Institution.
So it's funding culture and academia. The rest, about 33%, is the free float, traded publicly. It's a fascinating balance of power.
It really is.
Speaking of power, who is steering this ship in 2025?
Well, the board is chaired by Adnan Bali. He's a veteran of the sector, with Hakan Aran serving as the general manager. It's an 11-person board.
I was looking at the composition. We have Güzide Meltem Kürkten as the vice chair and Shibna Maydin as a member.
So that's 2 female members.
2 out of 11, so roughly 18%.
It's a metric investors are watching more closely these days. Governance diversity. It's decent, but, for a modern global bank, there's probably room for improvement there.
And since we're on the human side of things, the report discloses the benefits provided to key management. For this period, that figure was 1,648,765 TL.
Which, when you think about it, relative to a 5 trillion lira balance sheet, seems incredibly modest. It certainly doesn't look like they're looting the treasury for executive perks.
So we have this massive, highly regulated organization. How would you sum up their position before we dive into the numbers? A quick swap.
I'd call it a financial fortress. For strengths, you have that massive asset base and the diversified income stream we mentioned. Insurance and investments cushion the blow if lending slows.
And the stable ownership.
And the stable ownership. Weaknesses, high operational costs. Running nearly 1,000 physical branches is expensive in a digital world.
A heavy backpack to carry.
For sure. Opportunities. I'd say Asian expansion. We'll talk about Hong Kong in a bit. That's a major strategic move.
And threats are obvious, I suppose.
The macroeconomic environment. Inflation. Volatility. That affects credit quality. The bank is strong, but the weather is stormy.
Okay. Now we can move on to our analysis. Let's get granular. You mentioned that 5.39 trillion TL asset figure.
Yes, that's for year-end 2025. If we compare that to the previous year, 2024, assets were 3.86 trillion TL.
That's a massive jump. I mean, nearly 40%. Is that just the bank getting bigger, or is inflation playing a huge role here?
It's a mix, and that's the trillion lira question, isn't it? Lending volume has increased, yes, but we're in a high inflation environment. Currency effects and inflation naturally inflate the nominal value of these assets.
So while the growth looks impressive on paper, you have to view it through the lens of purchasing power.
You have to.
All right, let's look at the bottom line profitability, because assets are vanity, but profit is sanity.
The net profit for 2025 came in at 4.69 billion TL.
And that's up significantly from 3.01 billion TL in 2024.
It is. It's a solid growth story on the surface, but we need to see how they made that money.
The engine room. Interest income. They took in 842 billion TL in interest.
Which is way up from 599 billion the year before. But, and this is a big but, you have to pay to play. Their interest expenses were 686 billion TL.
So they're paying out a lot. That spread, the difference between what they earn on loans and pay on deposits, it's getting squeezed.
It is. But here's a number I love, and it's what saves them. Net fee and commission income, 123 billion TL.
Ah, I love that line item too. That's the quote-unquote risk-free income.
Precisely. That's credit card fees, transaction fees, asset management fees. It doesn't rely on a loan being paid back 5 years from now. It's cash in the door today. When credit risks rise, this is the cash flow that stabilizes the whole ship.
Speaking of cash, let's talk liquidity. The cash flow statement showed cash flows from banking operations at 146 billion TL.
And at the end of the period, their cash and cash equivalents stood at 864 billion TL.
Yeah.
That is a lot of dry powder.
And they need it. The liquidity coverage ratio is 117.76%. Can you explain what that means for us?
Sure. It basically means they have enough liquid assets, cash, or things that can be sold instantly to survive a 30-day severe stress scenario. Regulators usually want this over 100%.
So 117% is a healthy buffer.
It's a very healthy buffer. It means if panic hits the market, ISBank can weather the storm for a month without any outside help.
Okay, let's talk about the elephant in the room for every bank right now. Debt status, asset quality. Total loans are around 2.8 trillion TL, but not everyone pays back on time.
This is the critical part of the report. The NPLs, non-performing loans. The loans that are 90 days or more past due.
And the number is?
The gross amount in this problematic bucket is 85.6 billion TL.
That sounds like a scary number. 85 billion is a lot of money.
It is a large number, but in banking, the absolute number doesn't matter as much as how prepared you are for it. And look at what they've done about it. They have set aside, or provision, 102 billion TL for expected credit losses.
Wait. Let me get this straight. The bad loans are 85 billion, but they've put 102 billion in the piggy bank to cover them.
Exactly. They are over-provisioned.
Why would they do that? That hurts their profit today. That 4.69 billion profit could have been much higher.
Think of provisions like an insurance policy or an emergency fund. It reduces your profit today, yes, but it protects the bank's future.
So they're being conservative.
Very conservative. By setting aside more than the current bad loans, they're saying, we're ready if things get worse. It shows a really prudent management style. They aren't trying to inflate short-term earnings. They're fortifying the castle.
That puts my mind at ease a bit. It's the difference between a gambler and a fortress commander. Let's look at leverage. The ratio dropped slightly to 5.11%.
Which, again, just adds to that stability narrative. They aren't juicing returns with dangerous amounts of debt.
Now, ISBank isn't just sitting still. They're making moves. I saw some interesting activity in their investment portfolio.
Yes, the strategic moves. First, they sold a 50% stake in Green to Go Energy for $100 million to another subsidiary, Is Energy.
So isn't that just moving money from the left pocket to the right pocket?
In a way, yes. But it's an internal restructuring that crystallizes value. It cleans up the organizational chart, consolidates their energy holdings. It shows they're actively managing the portfolio.
And they're diversifying. I saw the acquisitions by Is Private Equity. They increased stakes in Tetilibudur, the travel agency, and Agrinatura.
It's fascinating, right? A bank betting on vacations and agriculture. But think about it. People always need to eat, and they'll always try to travel. It diversifies their risk profile away from pure interest rate sensitivity.
It's a hedge against the financial sector itself.
It is, and geographically, they're looking east. The board authorized opening a branch in Hong Kong.
That's a clear signal.
A very clear signal. For decades, Turkish banking was focused on the West London, Frankfurt. Opening in Hong Kong says, we believe the future trade flows are coming from Asia. It's a long-term strategic play.
Okay, let's touch on equity. Shareholders' equity is sitting at approximately 590 billion TL.
That's the net worth of the bank. Represents about 11% of total assets, which is a healthy cushion. The paid-in capital is 25 billion TL, right at their registered ceiling.
I want to dig into the fine print for a second, the footnotes. You found something interesting about that pension fund.
I did. We mentioned earlier that the pension fund owns the bank. But the bank also has an obligation to the fund. There's a specific provision of 16.3 billion TL for the pension fund deficit.
Why does that matter?
Because it's a legacy cost. It's a defined benefit obligation the bank is on the hook for. It's manageable, but it's a unique liability that just sits there.
And the auditors, PwC, flagged something specific as a key audit matter. They pointed to the TFRS 9 calculations.
Chuckles. The dreaded TFRS 9.
Can you translate that into English for us?
Basically, PwC said, calculating how much money to set aside for bad loans is really, really complicated. It involves guessing the future of the economy, inflation, unemployment.
So it's more art than science.
It's a lot of complex math models. But yes, it relies so much on estimation that the auditors spend a huge amount of time just checking the math. It's the area with the highest risk of misstatement.
So what does this all mean for the person listening right now? If we zoom out, we see a bank with 5.39 trillion in assets, making 4.7 billion in profit, but carrying 85 billion in bad loans.
Here's the summary. Bank is a financial fortress. It has incredible scale and diverse income streams, fees, insurance, investments that protect it when interest rates get wonky.
But it's operating in that high inflation, stormy environment.
Exactly, which explains why they're hoarding cash and setting aside massive provisions. For the retail investor, the story here is one of resilience.
They're managing the bad loans aggressively.
Over-provisioning, in fact. And they aren't just playing defense, they're playing offense with the Hong Kong expansion and their digital growth.
It's a balancing act, managing the legacy of the past while trying to build the bank of the future.
And doing it while being owned by their own employees.
Which brings me to a thought I want to leave you with today. We talked about the ownership structure, the pension fund, and the Ataturk shares. The dividends from those shares don't go to private pockets.
They go to state institutions for history and language.
Right. And it raises a provocative question, doesn't it?
It does.
Is Bank merely a commercial entity, or does it function more like a national trust? How does this unique ownership structure insulate it, or perhaps expose it, to different kinds of pressures compared to a standard private bank?
When your profits fund national history, does that change how you assess risk? That is something to think about. It certainly changes the definition of shareholder value.
It's not just about the stock price next quarter, it's about the preservation of an institution.
Well said.
If you enjoyed this analysis and want to help us keep decoding these massive reports, please hit that like button. It really helps the algorithm find other investors like you.
And subscribe to the channel so you don't miss the next deep dive. We have more giant balance sheets to unpack.
Share this content with other investors who need to see the big picture. And if you really want to support the work we do here, consider becoming a channel member.
You can also show support via Super Thanks. We appreciate every bit of it.
Thanks for listening. We'll see you in the next one.